Well, good evening and welcome to this live stream event. Another Tuesday, early March, 2nd in fact, of course, today. Only 28 days from, from the second last month, of course, because February had 28 days. Martin North from Digital Finance Analytics here. A lot to get through this evening. A lot of people on already. And good to see so many regulars come back, but also a few new names too, so welcome to you all, and really pleased that you've chosen to spend a bit of your Tuesday evening with me. What I'm going to do first of all is just go through some of the early slides and some of the data. During that time, I won't be looking at the chat particularly frequently, so if you've got specific questions for me, hold off and I'll tell you when I'll be looking at the questions. And with that, well, let's just get the show underway. So the running order for today, as normal, it's pretty standard. This introduction, the house rules, about our models, some key slides, and then we'll do some questions and answers, and then move on from there. Sign off probably 9:30, maybe a little bit later. There's just so much going on at the moment with regard to all of the questions. Lots of issues, of course, tonight as well. And in terms of the house rules, just want to highlight a few things as normal. This isn't financial advice. I really have to say this every time. This is just analysis. It's data, but it's not financial advice. I'm not qualified to give financial advice, so please don't take it as such. It is simply based off data. Do please play nice in the chat room. No racial slurs. The chat is moderated. I have in the past had to turn a few people off, and don't like doing it, but you know, if people get overbearing, they do disappear. This is as at the 2nd of March. Why does that say the 3rd of March? I'm ahead of myself. Anyway, 2nd of March. Whoops, sorry about that. Do use Walk the World if you want to get my attention on the chat. There's always a lot of stuff going on in the chat there. Frankly, I don't necessarily follow it all. There's just way too much going on. But if you use that Walk the World, there's a really good chance that I'll see your question, and then there's a chance that I can answer it. Of course, if you want to use Super Chat, you can get to the top of the queue. That's one way to make sure that your question gets spotted. Or indeed, if you'd like to make a contribution to the ongoing running of the show, we don't do this for profit. We do this because we think it's important to talk about this stuff. So that's always an option there to use Super Chat. Now, in terms of our models, just for those who've not seen this before, we survey households on a rolling basis, 52,000 a year, 1,000 a month. And all that comes in, and 1,000 a week, I should say, 4,000 something a month, and that goes in to drive our models. We pull information from multiple sources to be able to analyse everything that's going on. We use that then to run projections in terms of where prices might move, for example, and the data comes in weekly, so the information is as at last Tuesday. We also cut and slice the dice and look at the information across multiple dimensionality. Rubik's Cube is often used as the analogy there, so we can look at by location, type of household, all sorts of things like that. All that's pretty important in terms of understanding what's going on. And we can also then take our universe, drive scenarios out of it, and we'll talk about the updated scenarios tonight, what's going to happen over the next little while. And that's quite important, because when you actually start thinking about house price scenarios, you can take our mortgage stress data, our price trajectory history information, the buying and selling intentions, the migration statistics, the economic statistics, bang that all in through the core market model, run it through our scenarios, and then calculate at a postcode level or roll up to a region, state, or Australia level to be able to make some estimation of where home prices might move to. That's quite important now, of course, given everything that's going on. Now, of course, the Reserve Bank was very non-active today. They released a statement, and we'll just go through quickly. Not much change, but more QE is the way I interpret it. So they started by saying that they're going to maintain the policy settings. That includes the target of 10 basis points for the cash rate and the yield on the 3-year Australian government bond. And of course, the term funding facility was also discussed. The outlook for the economy is bumpy, uneven. And they also made the point that the longer-term bond yields have varied considerably, and they're talking about positive news to do with the vaccines, fiscal stimulus in the US, and that move on the bond rates is essentially signalling some of the new threads coming through, but making points, of course, here that exchange rate might be impacted. They're worried about the exchange rate. It's way too high at the moment. Then they went on to talk about the economy. Recovery is doing well, they said. GDP is expected to grow by 3.5% 2021-2022. Decline of unemployment to 6.4%, and that's still way above where it was previously. Remember that that's not a proper figure because JobKeeper numbers are not in those numbers. They're basically then underscoring the critical point. Wages and price pressures are subdued and will remain so for years. So they're not seeing a big bounce back in inflation, neither are they seeing a bounce back in wages. The economy is still operating with considerable spare capacity, and the unemployment rate remains high. And if you look carefully, they're basically saying there's got to be a tightening of the labour market to generate wage increases. And with unemployment still around 6% by the end of this year and 5.5% by 2022, it's unlikely that we're going to see anything significant in terms of inflation. In fact, they're saying 1.25% in 2021 and 1.5% in 2022. CPI inflation is expected to rise temporarily because of the reversal of some of the COVID price-related reductions. And that's important to understand. So there will be potentially a short-term blip in terms of inflation, but that's to do with the unwinding, not to do with structural changes in the economy. We'll see. Others, of course, around the world are believing that inflation is going to be more rabid. I'm probably not in that camp personally, but I'll explain why that might be a bit later. Then let's just look at the other comments quickly. They basically said that the policy settings will continue to support the economy, that lending is going to continue. Of course, rates are very low. Lending standards remain sound, they say, and it's important they remain so. I have my doubts about sound lending standards, particularly when people can get 8 times income to get a mortgage, which is what's happening at the moment in some cases. And then they went on to talk about the bond purchase program. They bought more than they were planning to. They basically extended that program. They're going to buy some more bonds, and the bank is prepared to do more if necessary. And the ADIs have tapped up 91 billion under the term funding facility. They've got access to another 94 billion. And of course, the Reserve Bank's balance sheet has gone through the roof, up 175 billion. And basically they said, we're committed to doing anything we can to support the economy to get inflation between 2 and 3%. And that means we need wages growth, and that means it's going to take a long time. So that's basically their thought. So really was very little new stuff, frankly, in that information today. Now, The Economist and many other people are saying get ready for more bond market scares, and I think that's probably right. We are going to see this potential battle between central banks and the bond markets in particular. And my theory is that over the weekend, central bankers got together and essentially had a big discussion about how much liquidity to put in and where to buy bonds and things. It was coordinated, what happened over the last couple of days. And not surprisingly, therefore, the rates dropped back temporarily, although I'll show you a bit later. Temporary is the key word. And I think we're going to see more of it. So it's not solved. I think we're going to see more of it ahead. And now, in terms of other information that's come out today, the Roy Morgan ANZ consumer confidence was higher. It's now sort of at the long-term average. It wobbles up and down, of course, every time there are lockdowns. It drops and then it comes back. And interestingly, the expectations on inflation ahead has gone up as well, they said. And then CoreLogic, of course, reported very strong property price growth in February and nationally over the month up 2.1%. Not uniformly spread, of course, as you can see there. And even the annual rates are not uniform. Backwards in Melbourne, minus 1.3, and stronger in some of the smaller areas, very strong in Darwin, of course. Darwin has had many years of very negative property price momentum, so don't read too much into that. It's also very small volume, so don't read too much into that. And you can see there the median values. Now, whether you believe this data, I'll leave you to decide that. My own view is, bearing in mind how they come to their numbers and the fact that their information is somewhat delayed simply because the settlement data doesn't come through for 2 months or so. I don't know how they can be so brazen about this at the moment, but there you go. That's just their particular statement of what's going on. And they also, of course, had something else to say as well with regard. Whoops, what's happened there? Here you go. Try that. Yeah, that's the month-on-month changes, just so you can see how that's looking. And then they showed the data with new listings rolling off. So in fact, the black line there is 2021, and you can see that the listings are 140 compared with 220 over the last few years. And then the rolling 6-month sales volumes, they're saying, well, it's gone up a bit. Sure, has gone up a bit. Units, not so much. Houses, pretty strong. A lot of that, of course, is in the regions. And you can also, I think, take a view from other people who may be saying, well, listings, fallen. SQM basically said, yep, significant listings down 13.1% over the year. New listings, small movements. In some cases, it's more significant. Sydney, more significant perhaps. The older listings, significantly down. And basically, Louis Christopher's statement was the key takeaway from February's property listing numbers is that despite the rise in new listings nationwide year on year and month to month, absorption rates are picking up pace so much that total listings actually fell over the same period. Right now, demand is swamping supply. And nowhere more is this the case than in regional Australia. And that is the point. All of this is in regional Australia. Now, Cookie Boy sent us through the domain data, 191,000 listings and 33,700 under offer. Those numbers are down a bit compared with previously. And SQM's auction results, which is the ones that I think are most accurate. You notice the 72% for Sydney, not the 90-something% that was claimed. Obviously, Sydney tends to use auctions more than some other centres. Melbourne 57%. And it's worth just making the point that at the time of publication there could be minor tweaks and changes, but it gives you a flavour of what's going on. Of course, in some of the other centres, auctions don't really happen much. Now, in terms of other information, the dwelling approvals data came out today from the ABS. It fell 19.4%. Private sector houses fell 12.2%. And sector dwellings, excluding houses, remain very weak, falling 39.5% to the lowest level recorded since January 2012. Now, that's really important. The apartment market is in sharp decline. And of course, home builder subsidy was cut from 25,000 to 15,000, and that's one of the reasons why we're seeing the fall. So remove the stimulus, and things go backwards. They also published the goods and services surplus data, 18.1 billion. That's a rise of 4.4. And exports of goods and services rose 7.9, while imports of goods and services rose 3.5 billion, or 4%. And the deficit on primary income increased to 3.2 billion. And that's the 7th consecutive quarterly current account surplus, driven by strong exports of metal ores, up 3.7 billion, and cereal grains, up 1.3 billion, on the back of growing conditions, of course, that were doing quite well at the moment. Imports grew, though more slowly. And there was a little bit of stimulus from the asset instant write-off from the government as well, particularly around transport. Overall, I think that says that the GDP number, which will come out very soon now, of course, is probably for the year going to be down about 1.8, 1.9, but the quarter will be up 2.5. Now, just to remind you, the credit aggregate showed that housing grew at 3.64% overall. That's a small rise, but not a dramatic rise. Owner occupation rose to 5.68%. Again, a slight rise, not massive, but a little bit up. Investment, very slight rise. Personal lending was way down. And, of course, business credit dropped off a cliff. So not a huge amount of real support here. And what that means is that all credit grew 1.72% annualised. And broad money is at 12.82%. Now, of course, at least we're still reporting broad money. Some other countries are starting to report less on some of these rather important metrics. In terms of selected portfolios, just worth noting that Commonwealth and Macquarie are driving the way. Westpac, of course, is also writing loans as well. National Australia Bank didn't write additional investment loans. Remember, this is the net of new loans, old loans paid off. New home loan commitments were strong according to the ABS in January, and you can see there the peak both from the owner-occupied and investor. Owner-occupied much more than investor, of course, and that excludes refinancing. You can see that included construction. Of course, the government stimulus package was there, plus the purchase of existing dwellings. And investors are waking just a little, but actually, if you look carefully, it's mostly houses, not units that they're buying. Growth is widely based across the states, so this is a significant broad-based recovery in terms of momentum, in terms of new loan commitments. But it's really important to understand that commitments aren't necessarily the same as drawn down loans. First-time home buyers, of course, very strong thanks to government incentives, pretty much where it was back in 2009 at nearly 17,000 plus. So first-time buyers piling in. But just a note, funded loans and committed loans are not the same. So all those loan commitments may not necessarily translate into funded loans. And in fact, if you look at the data, you'll see there that overall the proportion of loans funded was significantly lower than those approved. So there might be delay, or it might be that people get approvals and then don't actually transact later. So it's worth watching that down the track. Also, just this from Westpac, just to highlight that wage inflation is well below trend. And this is a critical point, right? Because remember the Reserve Bank said, well, we need wage inflation to pick up because that's the only way we can actually deal with inflation. Well, all the data from everywhere I'm seeing suggests that wages are going backwards, if anything. And they've been going backwards in real time for quite some time. In real terms, quite some time. So that's a real problem. And frankly, this is not just an Australian issue, this is a global issue. Many wages are actually very, very low compared with where they were previously. That's a big deal. Now, interesting from MPA, according to the Australian Banking Association, 82,000 Australian borrowers are currently on home loan deferrals. That, of course, ends at the end of March. But interestingly, a lot of people who then try to refinance aren't getting the cheap loans. So the promise that this wouldn't actually impact your credit or creditability is not actually translating to practice, according to MPA. They're basically saying that those people on mortgage deferrals, even if you then start repaying, you need to show some history of full repayment before you can get the best deals. So that's quite interesting and quite different from what was promised. Well, what would you expect from the banks, I guess? The ads for jobs rose 7.2% in February, so there are some more job ads around. Of course, the question is mix of jobs versus skills, etc., but that's a significant and encouraging sign, I think. And let's go to mortgage stress, which of course is my baby. It rose in February. I was a bit surprised. I didn't expect it to rise so much, but it did. It rose from 39 to 41.8% in February. So 41.8% of households are struggling with cash flow. And the reason that it happens like this is three reasons. Firstly, we've got more people with bigger loans because they've been drawing down new loans quite recently, a lot of first-time buyers. Secondly, a lot of people are having to start to make repayments because of the deferrals now coming to an end. And thirdly, some of them are off JobKeeper and therefore are now having to either meet from their own resources, their mortgage repayments, or manage it some other way. So those three things are really impacting. A lot of SMEs are also caught. A lot of SMEs never got JobKeeper in the first place. And with all these lockdowns, particularly in things like hospitality and in retail, there are a lot of SMEs who are really struggling, and that means that they're not able to make their finances work. And remember here I'm measuring flow. So this isn't defaults, this is flow. Are people able to manage all their financial obligations, or are they having to cut corners? And basically, if you're in stress, it means that your net position means you're having to cut corners, you're having to prioritise, maybe put more on credit cards, maybe borrow from deposits, or get another loan or whatever to try and manage it. So it doesn't necessarily mean it's all going to turn to porridge tomorrow, but it does actually give us a longer term indication of what's going to happen ahead. Now, I can actually then just remind you that the income to debt ratio is reported by the RBA at 179. That's wrong, because that was, of course, all households, but only 1/3 of households borrow. So mortgage purposes, so you need to multiply by roughly 3 times, which basically says the average debt to income ratio is more like 3 times. And here is the data on the mortgage stress by state. And you can see there that the state with the highest degrees of mortgage stress, the Northern Territory, is at 50% and Tasmania at 59%. Victoria is at 45%, higher than New South Wales. That Victorian number is very much to do with the extended lockdowns and the fact that many households are still struggling as a result of that. WA is also rising. It was 39 previously, now 41. And that's partly to do with the new transactions that are going on, and partly to do with the fact that they've still got some issues with regards to income and employment. Rental stress is highest in New South Wales at 49% of households who are renting. It's pretty high in Victoria at 37%, and then we go down to ACT at 34%. Interestingly, previously we've had higher rental stress in ACT, but it's dropped off a bit recently. Average across Australia, 34%. Mortgage stress, 41.8%. If we then look at investors, so property investors, around 26.5% of property investors are underwater from a cash flow perspective, are trying to sell their property, don't have enough rent coming in, or indeed are trying to find somewhere to let it to. So there's a lot of spare investment properties that is vacant, particularly in the main urban centres of Sydney and Melbourne. Less so in some regional areas, less so in some Queensland, South Australian and also Western Australian areas too. 26.5%. And you can see there that the worst levels are in the ACT, New South Wales. It's pretty bad in Victoria and Western Australia. Queensland a bit below that, whereas in the NT, South Australia and Tasmania is not so much an issue. And then I measure overall financial stress, which is this aggregate measure. It's an aggregate of those 3 elements, and it tells us where the biggest issues are. The ACT and New South Wales have the highest levels of financial stress at 44% each. Then we have 39% in Victoria, 35% in Western Australia, 34% in Queensland, and it goes down the list, 38% on average. That's a big deal. That's a lot of households. 1.5 million households in mortgage stress, 1.7 million households in rental stress, 850,000 stressed investors, and overall financial stress out of the 9.7 million households is 4.1 million. That's a big deal. And this comes back to this fundamental issue that I keep raising, which is that you've got some portions of the economy doing very well, people in full work and doing well and are saving, but you've got this other group who are not, and that's why I keep talking about this K-shaped recovery. So there's some doing well, some doing not. What I'm spotting here are the ones who are not. And unfortunately, I don't see a way out in the short term of this particular set of issues that we're seeing. Let's then just flip over to look at it by our segment. So this is actually a mutually exclusive set of data looking at different types of households, from young growing families and young affluents through to battling urban disadvantaged fringe, exclusive professionals, the most wealthy, and then other groups too. And you can see that from a mortgage stress perspective, the highest stress is among young growing families. That's been quite consistent. And then it's amongst the urban fringe and those on the edge of town. Those 2 areas. A lot of those have bought new properties and maybe not the plan quite recently, and that's where a lot of the pain is. Also, I'll highlight some of the multicultural groups are also in difficulty. Exclusive professionals at 33%, not doing too well either. Some rural issues too, and then mainstream suburban as well. So it's quite widespread. If rental stress is most significant amongst the mature, stable and multicultural groups, but we see it quite broadly spread, and 38% of young growing families and 47% of young affluents are struggling. That's some significant, 47% there of young affluents, because they're often living closer into town, yet their incomes are actually under pressure and they're having difficulty servicing those rental streams. And then if you look at the investor, you can see there that the investor footprint is 48% among exclusive professionals, and 55% among young affluents. So those groups are the ones with multiple properties, with very often a leverage situation, one property off another, and with vacancy rates and all that sorts of things. But you can see it's, again, quite widely spread. Obviously, the groups that have more investment properties are more exposed. And you can see overall how that plays out. The ones I'm most concerned about, ultimately, I think, are the younger groups, young growing families, a lot of first-time buyers there, the young affluents with first-time buyers there. A lot of those are going to have difficulty ahead. Then quickly, just going through the mortgage stress by location. So because of the lockdowns over the last few weeks, Victoria's really taken another hit. Narry Warren is the one that's leading now at 78.1%, or 18,000 households. Then we've got Tapping in Western Australia, areas like that, Hocking. It's 6065. They've been right up there for quite some time and are still there. Then we go to Toowoomba, areas around there at 59%. Just to explain, I'm sorting this by the number of households in stress, and I'm giving you also the proportion of households, and you can see there that the proportion is quite significant. But Berwick Harkaway, 91% of households in that postcode, or 17 out of 17,000, 8,000 are not doing too well. And if we go down the list, Chipping Norton, Liverpool, places like that, Ballarat, Sydenham, Victoria, Roxburgh Park, Victoria, Point Cook, Werribee, Victoria, back across to the west with Tamala Park and places like that, Hoppers Crossing, I always get that wrong, 3029. And then we go to other New South Wales one like 2567, which is including Mount Annan, places like that, Harrington Park, Frankston, Victoria, Cranbourne, Victoria, Pakenham, Victoria, Salisbury, South Australia, and so it goes on. So it's quite widely spread, and even down the bottom there we have places up in Tasmania like Launceston and places like that. So it gives you a bit of a flavour of what's going on. Then we can look at the same for the rental stress, and again here are the number of rental stress households and the proportion. Chipping Norton, Bidwell, Greystanes are up there. Then we go down to West Gosford, places like that, up on the mid-north coast, central coast I should say, Blacktown, then South Yarra in Victoria, Toowoomba in Queensland, Surrey Hills, Darlinghurst, a lot of people there, highly exposed at the moment, and so it goes on down the list. And then of course we have New South Wales 2000 right in close. It includes places like the Rocks and Millers Point, places like that. And then we come down to Wollongong, not doing well, Cranbourne in Victoria, Point Cook, Werribee, Derrimut, Victoria. On it goes, Springfield Lakes and places like that over in Queensland, Dandenong South, places like that. And then we have the South Bank. And so I just want to highlight again, Victoria 3006 and New South Wales 2000 are registering quite significantly there. Then I'll just go to look at investor stress. This is quite interesting because we have Mandurah and Meadow Springs, places like that, right at the top of the list. A lot of investors there in deep doo-doo at the moment. South Yarra, of course, as well. Hornsby Heights, Surrey Hills, Darlinghurst in New South Wales, Clovelly, Randwick, Greystanes, places like that. We can go down the list, some Queensland places, including Mermaid Waters, Bateau Bay, Shelley Beach, the entrance. So, Central Coast again. Glen Waverley, St Kilda. Now you can see some of the same ones. Cranbourne pops up again. Dawes Point, Haymarket, Millers Point, the Rocks. And so it goes on. So there's some interesting correlations between all of the different types of stress. And then we'll finally look at financial stress. And Toowoomba takes the biscuit with 40% of households, or 19,000 exposed to financial stress through one way. Then we go to places like Liverpool, Chipping Norton at 18,000. And then we go to Bidwell, which includes Lethbridge Park, Minchinbury, a few others there as well. And then we go to Cranbourne and Victoria, no surprise there. Point Cook, Darramont, down the list a bit to Ballarat and then Hobbs Crossing, Fountain Gate, Craigieburn, Grey Staines, South Wentworth and Westmead. You can sort of get the flavour of who's actually being squeezed. So it gives you a bit of a flavour of how it all is playing out. Now, let me just talk quickly about the stress mapping. I do have my stress map loadable, and here is the key. So basically what we're looking for is the orangey reddy colour means the most stress, and it goes down through, you know, the yellows and the greens and the blues down to the lowest. So if I load that up, this is actually the mortgage stress mapping for Sydney, and you can see there that you've got some stuff closer in, but a lot of it's to do around Liverpool, Fairfield, around here, up towards Blacktown, around there. And if you drill in a little bit, you can see there that places like Bondi is on the list. A lot of those are actually areas where you've got young affluents who've bought, but you can also see some of the other areas that are being impacted as well. It's quite an interesting patchwork in terms of the various things that are going on there. Now, what I can also do then is just quickly go to, let's go to Queensland next, 4,000. Okay, so we start within central Brisbane. Doesn't look too bad close in. As we pull out from there, you can begin to see some of the areas where higher levels of stress exist. It's certainly not as severe as some other places, but we do get the occasional hot spot, as you can see there. And as we come out, places like 4154 and 4155. And then if we come out further, we begin to see out towards the west, towards Ipswich. No surprise there, I guess. And we come out even further, we can begin to see places on the Gold Coast and north of Brisbane also being impacted. So again, it's quite interesting just watching the distribution. It's not uniform, but there are pockets there that are actually significantly impacted by mortgage stress. And then I'll just do the same thing here with 3,000. We'll go to Victoria next. Victoria, of course, still reeling to an extent from the closures that we had. And even close in, we are seeing signs of mortgage stress in some areas, like in North Melbourne, Moonee Ponds, north of Melbourne there. It's two very significant areas, Moonee Valley. And as you pull out, you can begin to see other areas. You go towards Hume and Brimbank. It's significant there. So north, it's quite a lot up towards Whittlesea. You're also seeing over towards Dandelons that way, and also over the other way as well. And if you pull out further, you can begin to see more of the damage. It's a real patchwork story. And we get to the point where we start seeing Ballarat coming in and places like that. And what I find fascinating is a lot of these areas are high growth areas, a lot of construction, a lot of new stuff still being built, a lot of stuff sold over the last few years, and very, very consistently exposed with big mortgages and big costs. A lot of first-time buyers still buying, of course, so it's pretty interesting. If I go to 5,000, I got complaints last time I didn't do Adelaide, so I'm going to do Adelaide this time. So this is looking at Adelaide. We're drilling in from 5,000 and then stepping back. And it's not too bad, but again, you see some pockets of stress as you begin to step back and look at it. North of Adelaide and to the up into the Adelaide Hills, we're seeing some of that's actually also to do with some of the recent bushfires as well, I should say as well. But you can see that there are a few significant pockets where stress is quite high. Other areas not looking as bad. So again, you've got to go granular to really understand what's going on here. You can't just talk generically about house prices or stress or things. You've got to go granular into particular postcodes. If I then go over to 6,000, which of course is Perth. Again, interesting stories here. We are seeing some pockets of stress beginning to arise because of the changes in the market recently. And interestingly, some of the people who've committed recently to properties with more extended mortgages are already showing signs of some difficulty. It's nowhere near as bad as some other places, as you would expect, because the economy is perhaps a little more buoyant there than previously. But as you pull out, you start to see some areas north and south of Perth where there are issues. Rockingham, they're just showing up. And if we come down towards Mandurah, the issues there too. So typically the areas that you might expect in terms of what we're seeing, but it's not as significant really compared with some of the other places we've looked at. And then if I go to 7,000 to do Tassie, can't leave them out. Just pulling out in and around Hobart, you can see that there are a few areas. 7009 is an area that registers. We do have people with difficulty here because prices have shot away, incomes have not, and many people, of course, are still exposed to the fact that the tourism industry is pretty limited at the moment, so that's definitely having an impact as well. So you can see some of the Hobart ones there. And then finally, let me just do one more. We'll just do 8,000 or 800, I should say, go up to Darwin. Look, very low numbers, of course, of households, so the sampling here is a bit more suspect, but you can begin to get a bit of a flavour quite quickly. So again, a little bit of pressure in some areas, nowhere near as much in terms of the proportion, and of course significantly supported now by significant price rises. So all of those things are helping, but nevertheless, we keep an eye on that too. So there you go. That's the story with regard to mortgage stress. And let me now go back to this. Okay, just quickly on the scenarios. As I've said before, I'll say it again, the scenarios are just ways of thinking about different futures. I'm not forecasting, I'm just showing you the different ones that might be there. We run the 4 scenarios forward from today, and this is the current set. Hardly any change from last month. We did increase the QE in our best case. This is, assuming the vaccination gets rolled out quickly. There's still a significant probability of price rises over the next 2 to 3 years now, based on what I'm seeing, based on the very low rates and everything else. But there is also a considerable issue relating to whether that's going to be derailed by longer-term crunch because of more virus issues and variants. And, you've got to be conscious, perhaps, of more significant downside. Nevertheless, we are actually picking the more positive scenario as our base scenario for purposes of our modelling at the moment. So that's where we are at the moment. And just quickly on the postcode tools, just to explain, the tools are not quite ready to be launched yet. We're doing a bit of work to modify them and update them, but the postcode tool is online, and I've got some postcodes to put into it shortly. We will shortly then be moving it up into production, and at that point we will be contacting those in our Patreon program first to be given first access to it. There is a lot of good functionality now in the tool, and what I'll do is I'll make a separate show once that tool is good and ready to go. So watch that space. It's pretty close now. We just haven't quite got it done in time. But what I can do is bring the tool up like so. And I had a couple of postcodes to talk about before I come back to the questions. 6169 was one I was asked to do. So that's that one there. And this is just a good illustration of the way that the system works. So what you get is essentially the stress data and also some projections in terms of home prices. So in this particular postcode, which includes Safety Bay, Shoalwater and Wombrou, there are 15,000 households, 6,800 borrowing, 6,200 renting, 4,600 properties for rent and 5,500 property investors. The overall stress metric is 50%. That's quite high. Anything above 40 I get worried about. There's a 38% of households in mortgage stress. That's below the national average, but still significant. 4% default rate expected. Expect to see a few forced sales over the next few months. 55% of renters in rental stress, 3,400. 32% of investors stressed, 1,500, including 230 who are in severe stress. And in terms of the price trajectory, we are thinking that house prices could go up about 5% this year, come back slightly in the next 2 years. On our what we call our bullish case, that's sort of the best case, that's the one that I'm suggesting is likely to be coming through. If, on the other hand, things go a bit pear-shaped, then prices could fall. Units, significant potential for some rise and then a fall. So that's the trajectory that we see in that postcode. And then I was also asked to do, which I'm going to do now, is 4870. Somebody asked me that before we got going. Whoops, 4870. So let me just put that one in. 4870. Okay, places like Cairns. And there, 32,000 households, 9,900 borrowing, 18,600 renting, 13,900 properties for rent, and number of rental property owners, 8,900, 27% in financial stress. That's a lot lower stress than the other one we looked at. 35% of households in mortgage stress at 3,400, 3% in default, and 20% in rental stress, 70% in investor stress, so you can see why that's lower. And we're projecting rises of 8%, or 9% in fact, and then another 3%, and then a slight easing in our best case scenario. Our worst case scenario is a very slight fall, and our mid case just pretty much line ball up above. And units doing reasonably well as well. So there you go, that's that one. Okay, so let me now come back and see what we have in the chat. Of course, I've got a lot of chat to come up with, but this is one Cliff asked, 3888. Let's put 3888 in and see whether we can make 3888 work for you. 3888. Where's that one? No results found, it said. Have you put your postcode in right, I wonder? 3888. Yeah, don't know. I'm not sure that's a postcode. It's not. Doesn't appear to be a valid one. So sorry about that. Have another go. Maybe I misread it, or maybe I've got another issue. But 3217. Let's do that one instead. 3217 from Marcel. There you go. Let's put that up. Yep, I agree with you, Marcel. That's a growth corridor. But interestingly, the financial stress levels are not as high as some. 32,000 households, 9,900 borrowing, 18,000 renting, 13,000 properties for rent, 8,900 rental property owners, 27% in financial stress. That's a relatively low number relative to some of the others. 35% in mortgage stress, so that's a significant proportion, 3,400, 3% defaulting. Rental stress only 20%, investor stress 17%. So we're estimating significant rise this year in our bullish case, sort of 9% and then 3% the following year. Worst case, slight falls. A mid case, just above neutral. Units slightly different there. So there we go. Okay, and I'll do one more and then I'll go and check the earlier chat to see what I missed. Jason, thank you for that. I really appreciate that contribution. It's greatly received and helps us to cover the costs of the things that we do. It's busy old time. Whoops. I missed you. You moved. Okay, James asked for 5108. Let's try putting that one in. Those, of course, of you who've actually subscribed via Patreon will get all the data in a couple of days. I'll be sending it out on Thursday, all the update and the query table as well, so that you can look at it. Anyway, here's the result, and I'm just going to take the chat off to make it easier to see. So, 16,100 households in 5108. That includes Salisbury Down, etc. 7,400 borrowing, 7,000 renting, 5,300 properties for rent, 3,778 rental property owners, and 40% of financial stress. So not as high as some areas, but that's still quite high. 5,600 in mild stress, no severe stress. 75% though are in mortgage stress. That's a big deal. So there are a lot of people in mortgage stress. 200 risking default at 3%. Rental stress is low at 8%. Investor stress is quite low. So this is really a story of mortgage stress. There will be, I suspect, a lot of people who've bought quite recently, maybe a lot of new developments, a lot of big mortgages, a lot of younger households, I suspect, in there as well. Projections up 4% next 12 months, a small rise the following year, and a small rise again. So that's the bullish case. The bearish one is that prices fall slightly, and the significantly bearish one is that prices fall 10% over 3 years. Units following a bit close, 9% over 3 years compared with 6%. So there's more upside potentially in the bullish case, but the bearish one is down 13%. So there you go. Hope that's of some help. All right. Now let me go back up to the pick up some of the commentary and some of the other questions. Jerry makes a very interesting point about the listings, and that is that there are lots of listings that stay on the portals long after they're sold. Yep, that's probably true. I actually don't think the portals are very accurate at all. My analysis of what happens with regard to the real world relative to the portals is they're about 50% accurate, so they're not really very accurate at all, I'm afraid. Logan makes the point about the RBA aims to be the owner and lender of all. Well, the RBA is owning more and more of Australia. Look at what's happening in Japan with the Bank of Japan buying more and more of Japanese markets. They own more of the stock markets and other things too. The RBA is going the same way. The question is it going to take us anywhere useful? That's really the interesting question. Buildings approvals were booming. Yeah, really? Well, the latest data suggests maybe not. The fact is we had a bit of a boom, particularly for house construction because of the it's very strong support from government around home builder, but that's going now. And we're seeing, I think, approvals drop away. High-rise, hardly at all. And in fact, more high-rise development that was in train is actually slowing or being stopped. And there are more building companies going into receivership. So it's a story of two types of property. Houses, one thing, particularly high-rise units, another thing. Otto says the market's at war with central banks. Who will win? That, sir, is a great question. The truth, of course, is nobody quite knows, although the old adage was you never bet against the Fed. They have unlimited resources, and coordinated central bank action has definitely been happening recently to support the markets. The question is, have they been successful in doing what they were trying to do or not? And, I have to say I'm not totally convinced that they have been. If you actually take a look at the, let's say, I'm just going to pick one up here. Let's just look at a real life example of the market at the moment. I'm going to go for the Aussie 3-year because that's obviously the benchmark. Aussie 3-year is there. Okay, if I then push that should then go there, and then I should be able to show it to you. Let's go there. Okay, that's the Aussie 3-year. Whether it tells you too much at all, but the 10-year is quite interesting, right? Because basically, if you look here, you can see that after the Reserve Bank minutes came out, the 10-year went up. And that's what's happening. So what we're seeing is that there's a tussle between central banks and the 10-year. And in fact, the US is a bit the same. So this is real life data on the 10-year in the US. And you can see there that it's, let's roll that out. There you go. You can see there that it's going up again. So yeah, they are probably going to have to control the yield curve, not just at the 3-year mark, if they're going to be successful in holding this together. And the question is, can they go on doing that ad infinitum? And the short answer is, well, of course they can, because they have unlimited resources. The question is, at what point does that run out? And what is the impact of all that quantitative easing? Now, there are people who argue that the quantitative easing leads to potential inflation, all those things. Although if you listen to other people, and in fact I've got a conversation set up with Steve Van Meter on Thursday, we're going to explore this in more detail. The argument he makes, which I think I agree with, is that there is this transfer from one pool to another pool. It's an accounting set of entries, but it doesn't necessarily mean that it actually flows into the real economy. And if it doesn't flow into the real economy, you might not get inflation. In fact, very low rates and all that money flowing into the Federal Reserve, as it were, doesn't necessarily drive inflation at all. So it's a minority view, but I think it's one that we should probably still give quite a lot of consideration to, because if we don't get inflation, then what it means is that the reserve banks around the world will fail in their targets. Then what do? Do they do something completely different? Do they just try and talk the market up? So the tussle between the bond markets particularly and the central banks has only just begun, in my view. Let's see what else we've got here. Yeah, there's an interesting comment from Vanessa. Fed wire goes down and the 10-year rate goes to 1.5. Suspicious? Yeah, there's a lot of funny stuff going on. They've also stopped reporting certain things as well at the moment, of course. And so there's a little bit of shenanigans. We'll probably never know. And, of course, the reporting of precisely what they're doing and when they're doing it is always a bit suspicious. We know, of course, that the Reserve Bank in Australia bought $2 billion basically did a lot more than they thought they were going to Friday, Monday, to try and basically, I think, shock on all the market. But as I showed you from those results in terms of the rates, I'm not sure it necessarily worked. So it'll be interesting to see how it goes ahead. But no, there are some funny things going on. Now, Cross-Change asked this question, which is actually a very interesting one. Do you know how many first-time buyers stay in the house for 12 months to get the grant money and then move out and rent it? It was quite a thing. I was seeing it in some of my surveys. It's really stopped now. The reason for that is it's very hard to let the property out, unless you are in regional areas, but certainly in those big suburban areas where there's a lot of development going on, very hard to get people to rent at a reasonable amount. So people are caught. Many first-time buyers are getting into financial stress, not in the first year, but in the year 2 and 3 and 4. And so we're going to see a lot more of that. So I think that was probably a strategy that's probably proven to be rather ineffective. And this from Otto. So central banks are buying bonds furiously. It'll be hilarious if bonds go up in price and they're holding large paper losses. Absolutely, that could well happen. There are lots of hedge funds, of course, also taking positions, and don't underestimate the power of the hedge funds to be able to mess with the markets too. And volatility is the thing that they really want. And frankly, if they get volatility, that, of course, is going to be something which they will be able to trade on. And that's one of the things that we should probably reflect upon. I don't know whether you've noticed what happened to the volatility index in Australia today, but I might just display that for you because it's quite interesting, right? What do you think happened today with regard to volatility? Well, here's a clue. Let me get rid of that and put that up there. There you go. Volatility went through the roof. So that's pretty interesting, right? And guess when the volatility went through the roof? After the Reserve Bank announcement. So in other words, the markets are not convinced that the Reserve Bank is really serious about what it's doing. That's my read of it. And the volatility, of course, was very high. It was up at 18. It's 17 now. That'll be very interesting to see where that goes. And by way of comparison, the volatility index in the US is actually stirring slightly, but it's at 23, so it's not really gone up nowhere near as high as it was previously. So the US market and the Australian market are actually functioning just a little bit different at the moment, in my view. Right, what else have we got? It's a very good question. Does mortgage stress include when you're building? I'm bleeding money at the moment with all the extra private inspections they've had. Yeah, so basically, yes, I try to get a total view of a household's money in, money out, wherever they are. So it's all dimensionality, including if they're building or whatever they're doing. So it's trying to be a gross position of all the money coming in, all the money going out. Is there enough money coming in to cover everything that's going out without actually raiding savings or putting money into loans and things like that? That's how I define it. Now, that's not the same way that many other people define stress, but it's actually the most accurate way of trying to get to the real fundamental view, which is effectively what's happening with flows. Another very important observation from Otto here. The RBA and government have sitting conning people into bigger loans, meaning less disposable income, aggregate demand and job creation, add immigration, floodgates, wages fall. Absolutely. Wages is the key here, Otto. I agree with you. And wages are going in the wrong direction. It's gone in the wrong direction since 2012 and will continue to go in the wrong direction. I don't see any of this to, frankly, support higher wages growth. And in fact, government came out today and said there aren't enough jobs around. So there aren't enough jobs for everybody who wants jobs. And of course, the job seeker process, or whatever it now be called, includes now applying for 20 jobs a month rather than a smaller number. Crazy times. Okay, what else have we got? Lots of interesting cross-chat, which I'm not going to look at. So if you want to make sure I see your question, do @WalkTheWorld. That's the best way to make quite sure. Lots of questions, lots of issues. I like all this chat. It's got some really interesting stuff. Cookie Boy makes the point, 3,000 a month leaving Victoria, yet prices are booming. How so? Prices are not booming everywhere in Victoria, right? Regional areas, they're quite strong. Houses in some areas are quite strong. Units, completely the opposite. I'm still seeing units down 20 to 25% in areas. Also seeing some of those outer suburban houses that were actually built over the last 2 or 3 years still going down in value. So yeah, it's not uniform. There is also, I think, a little bit of a change in the wind in terms of that migrator number. I think it's going to be lower ahead as well as the virus is more under control. Okay, style play. You said 2097. Let me see whether I can bring that up for you. Just a second. Need to do this first. Go there. Okay. Need to push so many buttons to get this all to work. There we go. Now I can go there, and then I can do that. Yeah. Okay. 2097. Coleroy. Yep. Bingo. There we go. All right. So 5,699 households, 2,600 borrowing, 1,800 renting, 1,400 properties for rent, 1,600 property owners for investment purposes, 25% in financial stress, 14% in mortgage stress, 5% risk default. A lot of these people here are on mortgage deferrals at the moment, so that's going to come to an end, and that could be a bit sticky for them. 20% in rental stress, pretty low. 53% of investors are having difficulty letting their property or trying to sell it. So this is an investor-led problem with a bit of stress thrown into the mix. Nevertheless, we are looking for a small rise this year and a slightly bigger one next year, and then a very small rise in year 3. That's the most bullish case. If you go bearish, down 7, down another 2, and down another 3 to 11% over 3 years. That's for houses. Units, you can see there is slightly different, but not a million miles off. Okay, there we go. Wayne asked this question, which is, whoops, push that button, there we go. Question might be, how many zombie mortgages are out there? Well, zombie mortgages, of course. APRA has said any mortgage that's been reset, any mortgage that's been renegotiated, any mortgage that any payment of any type is being made is not a zombie mortgage, right? So we are artificially suppressing the number of households with mortgage problems at the moment. Now, that will come to an end probably in March, Then you have to allow 90 days for 90-day arrears to arise, then 2 months to deal with that. I expect to see September, we'll start seeing the real numbers coming through, unless they change the game once again, which they could, of course, they could indeed do that. Okay, let's have a look down here. What else have we got? We're on the road to nowhere. Well, it's an interesting question, isn't it? Where are we heading? Well, I can give you two scenarios. One scenario is that the burden of debt continues to build, and the intergenerational mortgage burden just gets bigger and bigger, and we end up essentially with more and more people who never own their property and are just continuing to pay mortgage. It's almost like a quasi-rent, right? And you end up owing nothing, and you'll be happy. Oh, wonder where that came from. That is a scenario that we are seeing quite likely, I think, will play out. Debt will be extended. People will get used to it. They'll just pay it and pay it and pay it. It will be cash flow. And, of course, the banks love that. The banks love cash flow. That's all they want. They don't want you to repay your mortgage. They want you to keep paying the interest on your mortgage. They want you to basically be a flow of cash into the future. So that's what the banks want. Now, the alternative is we get a bit of a reset, prices drop, and in that scenario, we end up with a very different situation where the banks suddenly start getting difficulty with their books, and they start foreclosing and all those sorts of things, and then people get kicked out. So whichever way you go, it's a road to nowhere. It's just, I'm not sure which road we're on, but I'm not sure it's a road that I want to be on. But, this has been made by 20 years of bad policy. This isn't just the last few months. This isn't just COVID. This has been set. It's the Treasury, it's the Reserve Bank, it's those in power for at least a decade or two who've been doing this, and they're following a playbook of many other players around the world in central bank land as well. Okay, how else have we got? So did I do that one? 4870. I may have done that one. Let me just try and see whether I did it. Of course, my problem is, you see, I go back and then do some of the earlier posts, and if you've asked the question more than once, it may be that I've already given you the answer and not registered I've given the answer. Yeah, I have done that one. Thought I had. Okay, we won't do it twice. Okay, what else have we got? 5108 from James. Did I do 5108? May have. Let's have a look. Yep, thought I had. Okay. Okay. Yeah. Oops. One of the things that happens with the YouTube chat is it jumps around, so sometimes I miss some stuff. Bondi Steve says, interesting point there, Steve. Hi and welcome, by the way. Real estate market in Sydney, Melbourne, in all sorts of approval strife with a new terminology of sugar crush. Yeah, very good. Okay, Daniel says 3028. Let's see whether we can do 3028 for you. Laverton, Seabrook, places like that. Here it comes. I'm just going to get rid of the chat so you can see it. 11,388 households, 4,600 borrowing, 4,400 renting. Properties for rent, 3,400. Number of rental property owners, 2,500. 28% in financial stress. 42% in mortgage stress, that's a high number, 1,942. 3% risking default over the next 12 months. 19% in rental stress. 17% in investor stress. Price expectations, a rise, 2.2%. Then another 3 or 4%, and then slightly more, giving a 6.6% rise over 3 years. That's the bullish end of the spectrum. The bearish end of the spectrum is down 10% over 3 years. Units up 8% over 3 years, down 14% over 3 years. You can see. And just to explain, this gives you a sort of a corridor, if you like, between the two, right? I'm not saying precisely it's going to be there. It's going to be somewhere between there and there is how I do it. So it gives you a bit of a flavour as to how I do my modelling and thinking. And some of the critical questions here are what those mortgage stress people are going to do. Are they going to sell? Are they going to be forced to sell? Will they be able to refinance? Can they refinance and reduce their repayments? Those are all sort of questions which you have to sort of kick around to be able to figure out what goes on there. Neil, have I done that one? 4510. Not sure whether I have. Let me just give it another go. 4510. Whoa. Don't think I've done that one. Place like Belmere. Donnybrook. 19,457 households. 6,600 borrowing. 10,200 renting. 7,800 for rent. 5,400 investors. 44% in financial stress. Very little mortgage stress, 18%. 2% defaults. Rental stress, those high at 56%. And investors are struggling. So this is going to be an investor-led story once again. Nevertheless, we are predicting or estimating price rises of 7%, 3%, and a slight fall in year 3. Bearish, down 7% over 3 years. That's sort of how we see it at the moment. And I should explain I update this scenario every month, of course, as things change. Jason asks a very interesting and very important question, which is how many zombie businesses are there? The answer is a lot. So I do small business surveys as well, and I do see a lot of small businesses in retail, hospitality, and some other education, for example, really struggling at the moment. The more recent short lockdowns really just crushed them further. A lot in Victoria are really struggling at the moment, wondering whether they're going to come back or not. So I think it's going to be an interesting question. A lot of these are small businesses, so single owner businesses or small businesses with just very limited numbers of people. And it is true to say that some of those are going to really struggle. Remember, of course, that the bankruptcy rules got changed back, and we would expect to see more insolvencies later in the year. But again, it will take time to work through. I was speaking to an insolvency practitioner the other day who said that they'd already got more calls in the last month than previously. So we'll see how that goes. Now, Bryce, thank you very much. Appreciate that contribution. 5075. Should we do that for you? 5075. Paradise. Want to live in paradise. Sounds a lovely place, doesn't it? 4,400 households, 1,700 borrowing. Back there, I think will help. 4,400 households, 1,700 borrowing, 1,400 renting, 1,090 for rent, 1,300 investors. Mortgage financial stress 33%, mortgage stress 21%, so that's lower than some others. Rental stress is very high at 62%, 885 households. That's where I think we're going to see some pressures. It hasn't translated yet into investment stress, but it could later. But that is the real problem. That's the weakness there. Overall, 4%, a small rise again the second year, and then another small rise the third year. 6.6% over 3 years is what the modelling is suggesting. On the downside, drop of around 10%. On units, down 14% or up 8%, depending on exactly what it plays out. So I hope that's given you some useful information. Yeah, extend and pretend. There is a lot of that going on, There's a lot of that going on with regard to loans. And a lot of that going on with regard to property. And unfortunately, the information sources to allow us to really understand what's going on are being carefully filtered and manipulated and controlled. So we only get parts of the story. And, I've spoken with Edwin a few times about this thing about underquoting. In other words, agents put the price of the probably below what it really is worth. And what they then do is claim that they've then had this major victory simply because they started on a low base. That is rife. It's rife in many different areas. I have, in the last couple of days, spoken to estate agents in Sydney and Melbourne, as well as up in Queensland. In each case, they say, yep, it's just part of the furniture. So it's hard to get a real good read on what prices are. Also, if you go to the portals and try and read the information as to what price sold for, it doesn't tell you. It tells you about the last asking price. The only way to get the true information is to go and look at the settlement data. That's not easy to find in a couple of states, but in Victoria and in New South Wales and Victoria, you can see true settlement data, and that settlement data gives you the actual settled information. That's how I baseline my prices, because the settlement data is actually true, whereas all the other stuff is not true and therefore subject to extend and pretend. And this is all about the big lie, right? If enough people say it, enough people will believe it, and it becomes self-fulfilling unless you get better sources of information. So look at that settlement data and use that as a baseline to be able to understand what's going on. And Cookie Boy asked, how long will we see a 25 to 30 year mortgage deferred loans? Well, it's interesting. There is, in Japan, they've got intergenerational mortgages now. There's discussion about extending the terms of mortgages in other places too. And it goes back to what I said earlier on, Cookie Boy. The fact of the matter is the banks don't want you to repay your mortgage. What they want you is to go on paying and paying and paying interest. And in fact, they love interest only because, of course, that means that they've got this large slice of predictable revenue stream. That's all they're on about. So, yeah, one way to do it is to extend the term of the mortgage. I wouldn't be surprised to see 50-year mortgages. And frankly, if prices go on up and the lending standards go on looser, it probably will end up there, unfortunately. And Yogi Bear says kicking it out till after the Fed election. Yeah, that's probably right. Remember that ScoMo, before the last election, said he's going to make sure that house prices don't fall. He's very aligned to the property sector, of course. And, well, I suppose you could say he's being true to his word based on the latest data, although I'm sceptical as to how true that data really is for the reasons I discussed earlier. But nevertheless, the chances are that what they'll do is to try and pad things out. I'm a little bit less certain now that they'll go to the country as soon as he was perhaps thinking earlier. There's a few other scandals whizzing around at the moment, so maybe some of those will get dealt with first. So it may be later than we think, which might mean there'll be another round of stimulus. I am frankly expecting more stimulus, but more targeted stimulus at particular industries in particular ways. I know that the tourist industry is lobbying, the real estate sector has been lobbying for more help, right? Everybody wants more help, right? The question is that the right way to solve the economic issues we have? I suspect probably not, but there you go. It's not really about that, is it? It's interesting. Smooth Operator says, the Australian public sector is a protected species. I know I used to work for the RTA for 20 years. And yeah, it's interesting, of course, the pay rises in the public sector were stronger than the private sector. That was the latest ABS data. It's been consistently like that for a long time. So private sector wages are the ones that have really tanked. It looks to me as though they're putting more pressure on public sector wages now as well. And given the amount of debt in the system, it may well be that they're going to actually control that more significantly than before. Interestingly, of course, the other thing we should think about, in the UK, they're having a budget tomorrow. And there's a big debate going on there about when taxes will go up to pay for the huge debt that's been created. And interestingly, no one's here talking about tax going up. But at some point, taxes will have to go up. And the question is, which taxes will go up, how will they go up, and who will have to pay? And that is a question that we should be asking the politicians now, because otherwise it'll end up as normal with corporate taxes being cut and personal income tax being lifted, which means once again we're going to be paying more and more and more as a share of total tax take, which of course is what's been happening the last 10 years, 15 years or so, whilst corporates get away with blue murder. And of course the corporates got all the job keeper. Many of them didn't need it but got it anyway and haven't paid it back. So I'm afraid that the alignment between the politicians and the corporate end of town are very strong. I suspect that we're going to pick up the pieces as a result again. No, it's not a red whiteboard marker. I had a slight run-in with one of my dogs earlier on, who was very, very friendly and decided to give me a bit of a bump on the nose, which is, so that's the reason why my nose is slightly coloured as it is. But nothing worse than that. Nothing malicious. It was just a very enthusiastic dog. This is a good one. Zach says, keep kicking the can until your foot falls off and gets washed up on the beach. Oh dear, that's a bit, a bit close to the bone, isn't it, literally? And Cookie says, 10-year Aussie bonds on July the 1st will be higher. Definitely higher. Question is, how much higher? Otto says, people buying now are long-term renting from the bank. Yep, exactly what I said to Otto, exactly right. They are effectively long-term renters. And that's going to be an interesting story ahead, isn't it? It really is. How do they unwind it? Can they unwind it? No, I'm not sure they can. That's the problem. I got that one, I think. Okay, what else have we got? Alignment of government and the corporate sector. Now that's the hallmark of fascism, if memory serves. I'm afraid it is. That's exactly right. And the vested interests are much like... I'll give you an example. You know, the media reform, Facebook versus the other, you know, what's happened is there that effectively old media is now being paid by new media. Information from new media is going to be shared with old media. And they're going to have a nice duopoly of interests, right? Never mind everybody else. Small players won't get a look in. Another example of a really bad solution. Good for a small number of large corporate players, bad for everybody else. And unfortunately, I see that again and again and again. It's not good. Okay, Wednesday Brown says... Thanks for your ongoing hard work. Where can you find the settlement data in Victoria? Yeah, go to the Valuer General in Victoria. It's there. They publish it on a regular basis. It's not as granular as the New South Wales data, but nevertheless it gives you the monthly median price for each of the postcodes. If you can't find it, send me an email and I'll send you the link. And Jump Boz said, how do you successfully crash the market without crashing the market? Yeah, the issue is how do you successfully crash the market without crashing the economy, right? You can't. That's the problem. We've got ourselves wired into this one-way street. And in fact, the quantitative easing and the other programs that the central banks are doing, I can't see a way out. There's no one exit strategy that I can see other than to create a huge crunch. And that's, of course, why some people have been talking about this great reset or whatever you want to call it, sort of basically throwing out the old financial system, putting a new one in or something, right? My own view is I'm quite sceptical of whether that will actually ever come through, although if you listen to the World Economic Forum, they've been at it again. More adverts just published by the World Economic Forum talking about the need to do things differently, to the benefit, of course, of big corporates and the top end of town. And the trouble is that plans are being laid by the technocrats and the affluent few to the benefit of the technocrats and the affluent few and the big end of town, not to the benefits of ordinary people. And that's the problem I have with all of this stuff. It's not good. Thank you, Bryce. Because it's cheaper than a subscription to the advertiser, and I really like you. Thank you so much. Appreciate it. It's all good. And Brucey was just talking about metals. Don't buy paper metals. It's full fake and manipulated by physical metal. Yep. It's true to say that there's issues with some of those so-called paper representations of metals. Is there enough underlying to support them all? Maybe not. Big question here. Are you seeing an increase in underquoting? I've noticed a spike in offers over, which are low, and then selling far above that. Yep, absolutely. I mentioned it earlier on. Underquoting is a big deal. It's rife. It's because they can then claim the markets are really buoyant. They can also try and get more people to come in and try and bid. They're trying to encourage people to turn up at auctions, all of those things. It's more about theatre than reality. And as Edwin will say, the way to counter underquoting is to bid low, not high. And just a quick comment there from Siflix about synthetic products. Yeah, just be careful. There are some good, there are some not good. Be very cautious with some of those products. There are some that are actually, I think, a little shonky. All right, well, it's 9:23. I don't know where the time goes when I come on these shows. There's always way too much to talk about. What I'd like to do is just put a few more slides up, and there's a few things I want to talk about just before I finish off. I gave you the update on the tool. So I'm expecting the tool to be fully available and accessible within the next few weeks. Those on the Patreon will get first dibs, and then we'll spread it out more widely after that. Done the Q&A. Now, I've got some rather important things to share with you. The first is, I wanted to let you know, those of you who've been following me, Winston died. That's our three-legged dog. 16-year-old Labradoodle, and he died last week. I had to take him to the vet. He finally got to the point where he couldn't get around. So he was a wonderful dog. I made a number of videos with him over the years. He lost his leg on the same day that Trump got elected. And he had a good lease on life for the length of time that Trump was in power, and then started to go downhill when Trump left. But a fantastic dog. We've still got two other dogs, but in memory of Winston, he will be sadly missed. I also just want to mention this slide, and that is that if you look at valuations, this is actually looking at the overall US market and also the tech market. We're back up to bubble territory, right? It is frankly very interesting to see. So, the stock markets are well overvalued. They'll probably go higher for a bit because of the valuations and things. But the fact is, we are in for a bit of a shock at some point. The question is when. And just quickly talk about deposit bonds. I made a show the other day with a guy who runs a deposit bond company. I had a few questions from people saying, how do I get the discount? Because you can get a discount if you mention DFA. And the simple answer is, if you're interested in exploring the deposit bond, then if you're a subscriber to DFA on YouTube or on the Walk the World channel directly, just mention that, and you'll get a discount on deposit bond. It's an alternative way of funding a deposit without having to stump up money. It can be useful. Not always is useful, but in some situations can be quite useful. So just to mention that to just deal with that situation. And if you're interested in some of the other services, the walktheworld.com.au, where we talk about our funds, that's there. And I'll be recording another show with Nucleus Wealth quite soon on bonds. And I'm also going to be recording a show with Steve Van Meter on bonds as well. I do appreciate the comments with regard to Winston. Thank you so much. It is, bit of a shock when it happens. The fact is that he had a good life, and it really is one of those things. The hardest thing about having a dog is when you don't have a dog anymore. But I really appreciate those comments, and I thought I'd share it with you just so that you can understand why I've perhaps been a little bit under the weather the last few days. But anyway, all good now. And thank you very much for all of those comments. It really is really appreciated from the community. And yeah, I'm imagining Winston with 4 legs chasing rabbits in the sky. So that's that's really good. Thank you. And Cookie's got a 17-year-old cat. Yeah, cat's gone forever. We had one that was pretty old too. They're amazing. Yeah. Thanks, Otto. Yeah, no, it was just a bad timing with his with cancer on his leg, and I had to have his leg removed. So basically, the vet gave us a choice. You can either leave it and he'll be dead within a few months, or you can take the leg off and he'll have another few years. He had another 4 years plus, so he did really well. Very good object lesson. Vanessa asked, will I be doing a market update on this Saturday? Yeah, I hope to. I did one on Friday this last week because of what was happening. And Cliff, yeah, I'm recording one with Tarek on Friday. Got a lot to speak with him. And Cookie says he's looking down from doggy heaven. Yes, I think that's exactly right. Very good. And wow, Cat was 21. That's just incredible. That's a big number, isn't it? Very good. Okay. Now, let me just see whether there's anything else I want to cover. Yeah, just briefly. I'll get rid of that. Okay. Just for those if you want more information about DFA, go to the DFA blog. The link's there. You will find that you can contact me. There's a menu there. You can use either the contact me or the contact media page, or there's a little dialogue down at the bottom right-hand side on the blog that you can use to touch base directly with me. And send a message and I'll come straight back to you. You can also support our work via Patreon, and those on the US $50 a month gets the full stress data each month and also the movement projections. That will happen again in March when I send it out on Thursday. So all of those of you who have subscribed. And if you want to be one of the first users of the complete tool when that comes out in a few weeks, it'll be the same sort of functionality, but there'll be additional functionality too. Again, subscribe at Patreon and you'll be right first on the list. There are some other levels of service there as well that you can also get on Patreon. The link is there at the bottom there. And the $50 gives the stress data and also all the movement data as well. And also just quickly on the one-to-one service, still doing it. A lot of requests recently. If you want a confidential conversation with me about a particular suburb, I can't give you financial advice, but I can give you some very concrete data, including trend data and those things. And I can look at the stress data, the price trends, and make some suggestions as to where prices may go. And it takes about an hour via Zoom or by phone. And it's $250 plus GST, booking in advance. And at the moment, I'm about 3 to 5 weeks ahead. I can squeeze in urgent requests if it comes up, but generally I need to plan it just because I've got a lot on. But there is that offer still there, and I have a number of people who take it up. Quite often what I then do is publish a sort of summary of some of the conversations on the DFA blog afterwards in terms of a post. And just quickly to say, if you want to support me, you can also use PayPal, which is another mechanism which is working quite well as well. And even Bitcoin. I do have a bit of Bitcoin, not a lot, just a bit. And there's Merch as well if you're interested in a bit of stuff going on from us. I will refresh that in due course when I have time on my list. Now, next time, this is an important conversation. Louis Christopher's coming next week to talk about property trends. Louis Christopher from SQM Research is, in my view, the best property analyst in Australia. Great data, great insight, been doing it for years and years and years. And he's coming on the show. So you'll be able to ask him directly questions and deal with it. So that'll be, mark your diaries, 9th of March. And it's normal time, 8 p.m. Sydney. Lots of questions there, lots of chance to interact with Louis directly. So I'm really excited about that. Taking a bit of time to arrange, but it will be, I think, a really good show. So mark your show there. Cross Stitch Change says, what if we do want financial advice? I'm sure your advice and data together will be spot on. Yeah, well, the way to do it is if you want financial advice, Nucleus Wealth, which is the tie-up that I've got through walktheworld.com.au, can do that, right? So Nucleus Wealth manages a fund and also has access to financial advice. That was a deliberate strategy that I put together because I'm not able to give financial advice. I'm not qualified to do it, and frankly, don't have time to do it. But essentially, the combination of myself with the property information and Nucleus Wealth with the broader financial advice makes it all feasible. So that's the way to do it. Go to walktheworld.com.au if you want financial advice options. And Tim Fuller, who's the head of advice, has access to a range of different solutions. Another interesting question here, briefly. Will Harry Dent ever be right on his cycle? Well, it depends, you know. He's kicking it out because of the Fed continuing to do what they've always done. Not sure how it's going to go, but, you know, at some point, I think his cycles come to a sort of, you know, intersection point later this year. So I'll probably have him back on sometime later, and we can talk about that with him then, I guess. Cookie says, Tony and Damo are my favourite live guests. Well, that's good. Well, Tony is on the 16th. Damien is on the 23rd. And then I've got a special guest coming from Brisbane to talk about Brisbane property on the 30th. So that's how the rest of the month is looking alike. Okay. I think that's pretty much. I really appreciate those comments with regard to Winston. As Chris says, it's like losing someone in your family. It is. And worse still, you know the worst thing, Chris, is taking that trusting dog who's always trusted you to his last visit, knowing he's not coming out. That's the toughest part of all, I tell you. But there you go. Now, Junk Bond said, is Jolly Swagman still on YouTube? I'm not sure he's on YouTube. He's doing a number of podcasts, and he's doing weekly posts, but I'm not sure. If you do it, look at his website. I think that's the way to find him. Can you view interview Catherine Hanson? Well, maybe. Yeah, Vanessa, hopefully get that done on Saturday. And so Cookie's looking forward to the 16th, Tony. So come in on your long run and see what we can talk about then. Okay, I'm over time. So if you didn't get your postcode question answered, you can contact me via the DFA blog, and I will try and answer it over the next day or two. Really appreciate all of those who spent time with me tonight. I hope you have a good evening. Mark your diaries for next week. As I say, Louis Christopher's on. It'll be a really interesting show. We've got lots of good shows coming up during the week as well. So please take care. Thank you very much for spending some time with me this evening. And I'll see you next time. This is Martin North from Digital Finance Analytics, signing off.